I'm Henry Camp. Before I start, let me give you a warning. 70% of acquisitions do not yield the expected value, according to studies. So acquisitions can be good or bad. An injection you have is TOC. That too may turn out to be insufficient. Let me share what I know to help you do it right. The first place to start is culture. Nothing is so important as culture. If your people are unwilling, you will fail. There's a great book called Traction by Gino Wickman. It's simple to read and understand for you, for the people who work for you. And he starts with culture. You should start there too. Okay, into the presentation. Let's see what we can do. Let me start with my conclusion made from a presentation I made back in 2014 with a partner of mine in our own private equity fund. Across the TOC world, people complain that TOC is not yet, as Ellie Goldratt often said, the main way. By that, Ellie meant that most companies, and certainly the successful ones, are using TOC to guide their decision making. That has not happened. Therefore, you have an opportunity. You'd like greater wealth for yourself, better, more secure jobs for more and more people, a way to combat inflation, and stronger supply chains. Let me introduce you to the positive side of TOC not yet being the main way. Here's my claim. The lack of general TOC knowledge means that you have a decisive competitive edge. Here's what you do with it. 4 things. Find sources of capital. Build a team. Use TOC to make the company better. And repeat. I think you'll find the last one easy, particularly once you've done the first 3. Let me explain some ideas to help you consider each one. Everybody tells me, I don't have enough money. I could never buy a company. What if I failed? Let me ask you, who better to solve that problem than you? Here's the reality. Think about this with me. Since the COVID low in 2019, which I've marked here on this chart, stocks have risen to an extent that normally takes 20 years. Now think about it. How much more can they go up? As new long-term bonds come out with higher and higher coupons, the interest that they pay, as you can see that projected on this chart, what happens to the bonds that people bought back in 2020 with yields of less than 1%, or even 2021 at 2% yields? Obviously, these existing bonds, the ones already out there, are less attractive by comparison, and their face value falls. Now, do you expect interest rates to keep going up? I do. That means that bonds are going to be depressed. They're a bad place to invest. What else is hurt by rising interest rates? Why, commercial property, warehouses, production plants, office buildings, apartments, etc. Financing to buy rental property isn't too expensive when interest rates are low. When interest rates go up and rents are locked in, at least for the remaining lease term, naturally prices buyers are willing to pay decline. Here's what the world's top investor, the best investor in the world, has to say about these risks. Derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. This is from Warren Buffett. Now let me ask you, why in the heck would smart investors buy derivatives? After all, they're a true zero-sum game. It's win-lose. You win, I lose, and vice versa. So anybody trading in derivatives is saying, I know and you don't. Interesting. Exactly what Goldratt told us not to do in his last pillar of TOC. It was a collapse in one type of derivatives on home mortgages that caused the Great Recession of 2008 and 9 and 10 and 11 and 12. Put all these four factors together, and people who have money are in a crisis. There are going to be some magnificently stupid investments. I'm predicting it. Wait for them. They'll occur because of one particular thing happening over and over again. Let me generalize it. Some smart people will continue to think in ways that were brilliant, but are not anymore. In our current context, it's just completely changed. Now let's go back to your excuses for not buying a company. The last one was, let me see, what if I fail? You know the 5 focusing steps. All those smart people don't. Remember, TOC is not the main way. That's what we said. That was our complaint. Now I'm telling you that it's good. I'd bet on you any day. First and second excuses were, I don't have enough money and I could never buy a company. Why not? None of us can alone. We need a team. Some of the team brings the money. Some of the team brings the skills that you lack. I'll get into how in part 2. First, a real example of my own private equity startup back in 2010. Here's how long it took to raise almost $6 million. Our first purchase was Hawkeye Engine Services. I've presented on it at TOC ICO, and we were up with Hawkeye about 10x. Then the COVID hit and we dropped to 0. A recent cash infusion has us back at about 8 times our original investment. We expect to sell it for twice that within the next year. Our next investment didn't work out as we expected. We bought 30% and contractual management control. Now let me back off for a second here and tell you about contractual management control. So in the agreement where we purchased 30%, not a majority of the company, so we really usually wouldn't have any say. We said we want operational control because we can't guarantee that you're going to improve as much as we want you to improve without us being in control of your operations. And they said, okay, you know how to do this better than us. We'll give you control of the operations. So we wrote in the contract that we had operational control. This is a kind of a tricky nuance that you may want to be able to use if you don't want to buy a majority of the company. I'm going to give you examples later where you go ahead and buy a majority of the company. You don't have to worry about this contractual stuff. But anyway, just want you to know what I mean by 30. We bought 30% and contractual management control. And we're doing it to take advantage of a huge multi-year order for the equipment that Liberty manufactured that separates nitrogen from the air. But then the customer backed out. Still, we used TOC to double the company's value and sold our shares back to the owners a couple years later. We thought that was a worst case scenario too, until COVID stopped Hawkeye in its tracks. And why did Hawkeye stop in its tracks? Back to that just a little bit, because it sells parts that are going into rebuilt jet engines. So a 737 engine gets rebuilt with used parts mostly, unlike cars. With our cars, we buy new parts to put back in our cars. But with plane engines, these are perfectly good parts. We go ahead and put used ones that have been certified to be okay back in those planes to keep them flying. It saves about $2 million per rebuild to use those used parts. So it's a dramatic benefit. But when COVID struck, nobody flew, nobody was flying the planes, so they parked all the planes they didn't need. And the planes that needed a maintenance, well, they were grounded for lack of maintenance, but they had a parked plane over here, so they just flew that one instead. No maintenance was done. It was all deferred, and you can't blame them. They lost $245 billion during 2020. So why should they have spent money, operating expense on maintenance? It would have been crazy. So they didn't do it. And there's been now 2 years worth of pent-up maintenance that is just starting to be done. So Hawkeye is back together because of that infusion. I'll talk a little bit about it more later. Our last company was Java, which sells software that uses TOC to help facilities managers and roofing contractors finish more roofing projects each year. It's CCPM, in other words. We are at 9 times our investment now and expect to sell in early 2024 for about 20 times what we put in. I told you about what our companies do, only to point out that it doesn't matter what the company does. TOC can help it do things better and faster. Better and faster translate into multiplying your investment. You may think our returns look nice. I guarantee you that you can do better than we did. We made 1 million mistakes. So you can learn from our mistakes and beat these numbers. You also know that we can cool off the heat, this red heat that I'm showing out over here, with all this red type. Those are the problems. And we can cool that heat off from all this current risk because you know how to improve companies so that everybody wins, don't you? If you can operate companies better than they operate today, or help them operate better than they do today, you can multiply their value. There are investors already doing this now. Chris Graham in Atlanta, who manages Crown Capital, Ian Visser in Geneva, and me. And there are others too. You can do it as well. You want to buy good companies because you can grow a good company faster than you can grow a weak or a small company. It has middle management, it has the capabilities, it just needs focus to go. Now, the problem with good companies is this takes money. All you have to do is tell enough people with money about the opportunities and they will want to put their money into your deals. Now, warning, they need to invest huge sums of money. They can't do small deals that are a waste of their time. So each investment requires scale. What that means is that somebody has $500 million to deploy this year, has to take $100 million chunks at a time. Otherwise, they won't get through that many acquisitions in the course of a year. So it means it's easier to buy a good company than a bad one. So you can shoot for the stars. We just signed a deal, and this is what I promised to tell you from before, for $125 million now, plus another $125 million later to revitalize Hawkeye Engine Services. That's $250 million, and it came from a major institutional bank. Why is that important? Because banks are the most cautious investors of all time. Without an investor, Hawkeye was bankrupt. Without Hawkeye, the big bank couldn't get the return. Which leads me to the second point. But first, let me remind you of what it is. So back to my conclusion. So we've talked about raising money over here, but that blends over into part 2, which is about sharing. If you aren't willing to share, I think your objection, I could never buy a company, is correct. You can't do it by yourself. If you're not willing to share, you can't buy a company. I agree. Why? If you won't share, you must have everything that's necessary to make the project successful. If people with every skill exist, they must be horribly rare. It's easier to claim that finding such a genius is just impossible. Certainly, it's impractical. Now, let's check out our assumptions, like Goldratt taught us to do. How much sharing can we afford? To do that, let me give you an example. It's a simple example, right? First, let's talk about buy-in, getting agreement to do something inside the company. When you're a consultant, you explain what's possible at a level the client might believe. You don't want to be over the top. You don't want to be someone who overpromises and underdelivers. They agree with your assessment as a target, but don't they usually doubt that it's achievable? There are other things that distract them that they also hope may make some sort of difference too. Consequence? They don't pay as much attention to you as they should, and the results are less than what you know are possible. But if you buy the company, you speak to the management and the employees as a visionary. You paint the real picture for them. They see that even the sky is not the limit. They believe, especially after the very first step, provides significant results, which is in every one of Ellie Goldratt's strategy and tactic trees. They innovate a decisive competitive edge, build the capabilities to deliver it, and the means to capitalize on it in big enough markets where no significant competitor will follow without taking real risks or exhausting their resources. Success breeds more successes. Here are the different outcomes. In the consulting arrangement, you take no risk and you get $850,000 in just 2 years. Pretty good pay by any standards. You help and that feels good, but because you were working so hard for them, your sales channel dried up and you have no next client waiting on which you can move ahead. In the buy scenario, you get your share of the value. Let's calculate that, shall we? Here's our starting point. I think TOC consultants naturally think of their fees in terms of the added profits of the company they're helping. In this case, here are the improved outcomes the consultant gets for the client. Sales, TVC, and throughput are all up 10%. OE stays the same because you discover all kinds of wasted capacity. Wait a minute, can those money people do this? Can they find the wasted capacity? This is your expertise, not theirs, right? So you help the client redeploy this discovered capacity to handle the 10% increase. That gives them a 50% increase in net profits. Yay! If we assume they got an extra $3.5 million the first year and $5 million the second, as you see here, then your fees are only 10% of the total added profits. You can expect a very positive testimonial video, which hopefully makes getting more clients easier. Just ask them for it. They'll be happy. You've sold them $10 for every dollar they paid you. Very, very good. Now we've looked at it from your point of view. Now we want to calculate the value of the company. Now, why is the value of the company important? Because you should understand the client's point of view too. A nice company like this will sell for 7 times earnings. Why? Because after taxes, it would provide an attractive return for all those investors who wanted to get something on their capital that's currently producing nothing. In other words, just dry powder, sitting there not invested. Now, assuming 45% taxes paid to city, state, and feds, this means a 7.9% annual return on the investment. If the company grows, that's gravy. The return improves from there. Try the math yourself again sometime later. We're not going to go into that too much later. You can ask me, I'll explain if you don't understand. Now, what did your consulting do to the value of the client company? Wow, you increased the owner's stake by $50 million. Whoa. What percentage of the gain did you earn at $300,000 per year plus $250,000 bonus? Just 1.7%. Well, let's see how it works the other way. Here's the outcome when you call the shots as a majority owner. You can call as many meetings as is necessary to get the buy-in you need. When a company is growing rapidly, it earns a higher multiple. This because buyers assume continued growth, right? If it's able to grow, it'll continue to grow. Therefore, higher earnings are expected in the future. And so even if they pay more now, their return on investment will improve enough to justify it. And of course, what they're afraid of is that some other bidder will offer more money and they'll enjoy the value of the company instead of them. and they'll have to go to work all over again and repeat their steps with some new company. So a multiple of 10 is justified, and probably more too, but let's be conservative and just use 10x. Of course, you own 60% of the company, and it's 60% of a $500 million valuation. That's over 350 times more money for you after just 2 years. We just haven't figured out how to get you that $42 million to buy your 60% of this $70 million this $70 million over here that the company's worth at the beginning. Let's work on that. Here's what you need. Your first partner. You want a partner that doesn't expect too much. We call those types of partners banks. Get every bit of money you can get from a bank, because banks only charge 4 or 5% on the money they lend, and they don't want equity in your business. That's not their business. Why so cheap? Well, they can offer you these low interest rates and no equity in the business because they take no risks. That's the only way they can do it. If it doesn't work out, they'll come and take your collateral and sell it and recover the value of their loan. How much will the bank loan you to buy this company? Of the $70 million purchase price, they will lend what they call 3 to 4 turns. And turns, in this case, not inventory turns. Turns means multiples of annual cash flow. In this case, the company makes $10 million a year, so that's $30 to $40 million. To be conservative, let's say your bank will only go $30 million. Okay. Expenses will be around $1 million just to get this transaction done. So you still need $13 million more. And that's where a rich investor comes in. You make them a partner. Now, what percentage of your 60% do they expect for their $13 million? A lot. And it's probably reasonable. You can't do it without them, but they can do some other investment without you. So you need them more than they need you. Have you heard of the golden rule? He who has the gold makes the rules. So let's say that the investor demands 80% of your 60%. And that's not all. You probably need others to help you. Remember, you don't know everything, right? You're not perfect at everything, not experienced at everything. Fortunately, you can have the company that you're about to buy hire these people. But how do you get them, really good people, to come and work with you on your team? You've got to entice them, and you may need to share half of your remaining 20% with them. So on top of the existing staff in the company now, you may need, let's say, a proven professional manager to be the president who gets 5% of the company for coming. That's why he quits his other job and comes to work for you. Plus you're paying him. The new marketing expert that you decided you needed gets 2%. A vice president of production with simplified drum buffer rope experience gets 3% of your deal. And so that total is 10%. That means you only have 10% of your deal left for you. And maybe you can negotiate more than this. Maybe you can't. Recently, I knew a guy trying to negotiate. He had lots of experience trying to negotiate a 51% of the deal for himself, even though he put up no money. And after months, 3 or 4 months of effort to try to raise money, nobody else wanted to put in money into that deal. It was just not enough return for them to take that risk. They didn't think it was fair that the guy who only had the idea should get 51% of the deal. So that's probably not reasonable. Here, 10% might be unreasonable on the other end, but let's go for it, right? For now, let's just talk about you've accepted only 10% of your own deal. But compare that 6% to the 1.7%, and it's about 4 times more than you got paid for consulting. Plus, you can take a salary from the company too, so it's even more. It's even better for you than that. And lastly, don't forget that the outcomes delivered by you and your super team will surpass what most consulting gigs ever can deliver. So it's 4 times or 5 or 6 times of a much bigger number. See how well sharing works? This is not that complicated. So where were we? Oh, yes. Now, multiply your money. This is the easy part. TOC helps us with this. So same improvement as before. This time, you keep it all. How? Because you only got 30 million. So how did you buy this $70 million company when you only had 30 million? So let's go into that. This time, second time around, bank loves you. You're very popular when you go into the bank. So they lend you enough to cover the pickpockets. Oops, I mean your friends who help you get the deal closed. You put in 25 million of your 30 million and you keep $5 million in the bank to impress your wife or husband. So you still need $15 million more. Now I need to introduce you to a new source of money called mezzanine debt or mezzanine lenders. These lenders get a huge interest rate for taking a secondary position to your bank. And they're making this investment based on what you're going to do. Banks base their investment in you or their loans to you based on what you've already done in the past, the 3, 4, 5 years of financial statements, and then they'll lend you money. They won't lend you on what you're trying to do. The mezz debt people are the opposite way. They look at your business plan, what you're going to do, why you think you can do it, and so forth. They're not going to be able to take collateral because the bank's already taken it. But the mezz lender takes a position in front of you. So it means you have to make them their money before you get anything. And if things don't go right, you'll lose your ownership or some of your ownership to the mezzanine lender. But if things go as TOC people know they will, in other words, not everything will work right, but it will be much better than we were before, then the company will reduce inventory. So it'll go from this much to this much inventory. And that and the profits you make in the first year are enough to pay this $15 million off to the mezzanine debt financiers. And that means the interest, 13% of 15 million for 1 year, just under $2 million. Now, this seems like a lot, but you don't have to share the profits with these guys. Again, like the bank, you've gotten them in and out without ever sharing the upside of the company with them. So again, you include your key staff in your deal. And on your second deal, you've multiplied your $25 million into $450 million of value. 18 times multiplier. Wow. Now, step 4. And this is starting to get harder. Third time around, we want you to do it again. You may ask me why, because after the first 2 laps, you're already worth $450 million. And no, I did not forget the $5 million you put into your bank to impress your spouse. They spent it. It's gone. Poof, out of here. You don't have that money anymore. That $5 million is gone. But you probably enjoyed yourself along with them with that. So back to the situation. Why repeat? After such success, you may want to buy a plane and travel the world, or you may want to give money to some charity or a lot of different charities. Please don't do either. It's not as fun spending money as it is making it, because there is a risk of becoming haughty. Remember the 5th pillar of TOC. Never say, I know. Haughtiness comes from believing that you know. Give money to a charity and they'll spend it. The people they spend it on will just need more. You've made them dependent. Giving a charity too much will cause the charity to first expand and then implode. So if you want to do charitable work, start a company where you want to help the people. Give them jobs. That company can last forever and the people can earn what they need. They feel good about who they are. Now this is sustainable. The world needs people that keep growing and never selfishly opt out. That's one man's opinion. One man's opinion, mine. So as you keep lapping through the process, you need an agreed upon plan. It's not enough to know something about TOC. Lisa Ferguson and I presented this transitional strategy and tactic tree at the TOC ICO. It's the TOC International Certification Organization Conference in Chicago back in 2019. I won't go back through it here again. It's easy to join TOC ICO and watch the presentation. You can see the video. And feel free to ask me, send me an email and request access to the strategy and tactic tree. I'm happy to share. You do remember that sharing thing, right? So good for you, good for me. So how to know which company to buy? Again, you start with factual data. Stuff that you're given or that surfaces in the due diligence process. Due diligence, if you don't know that term, happens after the seller of the company signs a letter of intent, or LOI, to sell the business to you. Your lawyer will explain all this to you. That's why those guys are getting that $1 million. So you don't need to know all this stuff. They'll explain it to you. These are the types of things you can collect. Again, that leads you to what you can't know for sure. Fortunately, you have your intuition and the intuition of all your team of experts. I have an Excel template that you should use to estimate the best and the worst likely outcomes. These are two separate scenarios that plan out when you're going to implement each phase of the appropriate S&T. Then you estimate how much inventory will drop and when, how much lost sales you expect to recover because of better availability, and how well your decisive competitive edge will sell, et cetera, for every step in the strategy and tactic tree. Do this with the various companies you're considering, both ways for each company you're considering. And if this isn't your strong point, hire somebody. Remember, you're rich. Here's a repeat slide from my talk on intuition. The same thing applies to picking companies, which companies to buy. Heck, you can buy more than one. We did. Buying companies that are synergistic, right? In other words, that are working together is better than buying companies from separate industries. However, buying separate companies can protect you from a downturn in a particular industry. So just assess your risks as best you can. Up to this point, I've been speaking to you. But who is the you I'm speaking to? It turns out it doesn't matter. Now I'd like to be more specific. Let's say you have a company that already can be used as the core onto which you add acquisitions. In very many situations, there are opportunities for significant synergies. What I mean is that 1 + 1 could be equal to 3 or 4 or even 10. People can see from your company's financials that it's worth X. The same thing may be true of an acquisition target. Same size as you, they're also worth X. However, put these two companies together and wonderful things can happen. When significant synergies like these are present, put more effort into getting the seller willing to sell and less on striking the best bargain. The time you lose to delays can be extraordinarily costly. You can go for years trying to get a fair deal, and nothing happens at all. In other words, be willing to share a little of what you stand to gain with the current owners who make the synergies possible, right? It's not just you, it's them and you together. In chapter 17 of our book, the seller, Bernice, got too much for her company, and everybody won. There are also risks. Let me warn you about the disadvantages of traditional roll-ups, and then I'll share how they can be done well. Let's talk briefly about these roll-ups. Past results are, in a word, miserable. I don't claim that all roll-ups fail, but the vast majority do. What goes wrong? And if you remember how I started, it was with studies that showed that Plain old acquisitions fail to achieve expectations 70% of the time. Why are roll-ups even worse? This is rolling up many companies together. First, the need for communication across locations increases exponentially. Even more importantly, across various locations, there are strong leaders. If you roll up 50 to 100 companies in a short period of time, there are too damn many leaders, all vying with each other for control. This is usually a nightmare. They are each strong for a number of reasons. When you put this all together, there's war focused internally between these leaders that implodes the combined company, rather than the combined resources focusing outside for the benefit of customers. Why would people be attracted to such deals in the first place? My first two bullets are about economies of scale, aren't they? Inside the business. When you make a pro forma spreadsheet of what's going to happen, you'll calculate that the elimination of 100 accounting departments will save a lot of our operating expense compared to one larger, better managed one. The third bullet is also about efficiency, but a different type. Reducing the percentage of that deal that's spent to make it happen. And more importantly, do you remember when I told you that there's too much money in the world? That people who need to make investments prefer big ones because they're easier on them and invest more of the too much unproductive capital, getting it to work. Of course, if it goes down, getting it to work is a disadvantage, but nobody thinks that at the time they're making it. They make an excuse. So buying 100 companies, it's easier to get that money for 100 companies than for one, because one big deal is easier to do and invest much more. Let me give you an actual example. This is from my own experience. I own a distributor, and I was approached to sell it over 25 years ago. But and by the way, they were giving me too much money. But I decided I was too young to sell. But then I got worried when two of my competitors did sell and became part of this organization. It was a major vertically integrated public company that reasoned that their stock value might increase if they separated their distribution division from the manufacturing side. There was a $1.6 billion public offering with the funds used to roll up industrial distributors. I didn't figure this out. They offered me to buy my company before I really knew the story. I figured this story somewhat out later. 7 years later, they went bankrupt. And then 7 years later, they went bankrupt again. The new market capitalization after the first bankruptcy was $900 million. After the second one, it was down by a factor of 3 to only $300 million. This is probably a fair realized value for the company. A few years later, Great Recession time, they merged with another competitor who had done the same kind of roll-up pattern. And now the two of them merged together are worth $300 million. Do you see that this is not really magnifying the value of the investor's money? In fact, the investors over and over again are getting taken out of the deal. And then I just checked on this before this presentation. 9 years after the merger, their market capitalization remained $300 million. You can bet that the value, the cash value of the assets that the company owned were about $300 million. And there was no value for the company whatsoever. In the last year, they've made some progress finally, and they've surged ahead in market capitalization rate. And what happened was they started making a profit, just over 2% of sales. Sounds great, right? It's a distributor. 2% of sales isn't bad for distributors. Well, compare that to my company in the same business space, which earns at 3 times that rate. How is it that the smaller company is the more efficient one? Let's see how we can make this a good idea instead of a dangerous one. Here are some thoughts about how to do it better. Buying companies that already serve the same region allow them to be operated out of a central shared facility. This gives numerous advantages, such as headquarters and operations together in one place. This reduces the difficulty in communication. People can readily come together for meetings. It also allows more efficient use of a larger combined facility. The central warehouse concept works best to enhance turns when inventories are shared in one place. This alone will return money tied up in inventory into cash, and the effect of that is really the same as a reduction of the purchase price, because money that was tied up before you get to use to reduce the amount that you paid for the business. Every department will require smaller operating expense relative to sales. Picking companies that sell the same types of companies, in other words, they have the same customers, allows us to sell our products to the new companies, the acquired company's customers, and vice versa. Likewise, becoming a bigger supplier to your customers earns you more attention from the customer base. To avoid the war of managerial egos, and this is particularly attractive right now because the baby boom are aging. They've got the same color hair as me. So buying from a company who's owned by somebody who desires to retire reduces the number of chiefs. On the other hand, smaller companies typically can't afford full management layers. If you need managerial strengths in some areas, an acquisition can provide that, experienced people, or at least the throughput to afford the additional OE. If you think of these acquisitions as a series of bolt-ons, it can be much easier to finance. And last of all, don't forget Goldratt's admonition. Segment your markets, but don't segment your resources. Have one team that services the clients. Chapters 17 and 18 from our book, Throughput Economics. First, tell a win-win story. That's about Bernice and how she got too much and everybody won. And then explain why the story will work. Read them if you're serious about this. Now, let's move to questions. Thanks for listening.